This is a very interesting topic for me to talk about. I like talking about BRI, the Bank Rakyat Indonesia, or the People's Bank of Indonesia, which is over 100 years old, founded by the Dutch colonial authorities in those days. And it has a 100-year plus history of commercial microfinance in various ways, in the late 70s and then on through the 80s and into the mid-90s. I didn't live there, but I went back and forth a great deal. I worked directly for the Minister of Finance, who, when I first came, asked me to coordinate a program, this was in '79, looking at what's called the BRI units. They are like sub-branches, and they exist in all the sub-districts of the countries. Indonesia is a very large country, now the fourth largest in the world in terms of population. And this was a huge infrastructure which was used in those days in the 70s to supply large-scale subsidized rural credit programs, which failed in Indonesia as they failed in many developing countries around the world. And so by the time I got there, the finance minister was saying, well, we really have to either close them down or we have to turn them into commercial microfinance institutions. And we don't know whether that would work or not. So I and a number of Indonesians worked together for several years looking at the demand side. We worked pretty much all over the country. I mean, not every last place, but very, very much throughout the country for 3 or 4 years. There were two questions we were supposed to ask, basically. I mean, there were others, but these were the two basics. Would low-income people in the rural areas and in the urban, not the wealthy urban areas, but the urban, lower income peoples where they lived, would they save in banks? And there was a lot of thinking in Jakarta that at that time that probably these people wouldn't save in banks. One professor even went so far as to say that they were psychologically incapable of savings in banks. When we got out and talked to them all over the country, they said, oh yes, if the bank is going to give us what we need, and that's very close to the characteristics that I mentioned earlier, security, convenience, and so on, we would love to save in the bank because we don't like keeping our extra cash in the house. There's a security problem. There are all kinds of problems. Then, as time went by, I developed this method of asking people, what do you save in? And what do you like about it? And what do you not like about it? So then we got answers by people saying, well, I save in cash in the house, but it's a security problem. I save in animals, but there are several problems there. One is that sometimes they get diseases and die. And the other is that, as one man put it, I have got 10 goats, but that's all I have grazing. I can get the grazing for. I can't feed them more than 10. So what do I do now? I don't want to save in the house. I've got these 10 goats, but I can't supply any more food. The shepherds are all in school now. And so I could buy a cow with those 10 goats. But if I buy a cow, how am I going to pay the school bills? I cannot cut off the ear of the cow to pay the school bills. So like that, we went through all of the different kinds of things they save and what they don't say, what they don't like about it, what they like and what they don't like. And then we went back to the bank and sat around and looked at all this. And we realized that the bank would be able to provide all the things they have now that they like and get rid of all the things that they don't like so that they would have security, they would have liquidity and so forth. And so that was basically part of the building blocks of how the bank would go ahead developing its products and services. So then they introduced savings, and they did extremely well, except that at the beginning there was a pilot project, and it's a good thing too that there was a pilot project, because the work had been done so well that people really loved the products and services, but we hadn't been quite as good on the pricing side, so everybody was coming down. And we realized that unlike borrowers, where you can control how many borrowers you have, savers you cannot control, because if you send them away, there's a huge reputational risk, and they're not going to come back. They're going to feel ill-treated. So what do you do if you've got mile-long lines of people coming down with their savings? You have to really learn how to manage it. And in the pilot project, we learned that you have to really manage for uncontrollable growth. And for that, you have to have first-class management, because real strategic management, fortunately, they had it. And we were able to adjust and move on. And then there were 12 more pilot projects, and then they went national. And they have been, on the savings side, the leader throughout the microfinance history. They still are number one in the mix, global 100 for deposits, and very high on a number of other things. Another thing which is interesting about BRI is they became very successful and are very successful today. But it's very important to note that they were extremely stable during the East Asian crisis in the late 90s, at the time that the entire financial system of Indonesia failed. At that time, not only BRI, some of the smaller MFIs as well, but BRI was it was and is the very big one, and they just sailed through the crisis. Of course, people had savings. Obviously, the dollar amount, let's say, of the savings went down, but they kept on savings in rupiah because they wanted to keep their savings safe. These are low-income people. They really tightened their belts in order to have their savings safe in case they had emergencies. The repayment rate throughout the crisis on the microbanking side was just extraordinary. They had about a 98%, between 98 and 99% repayment rate throughout the crisis. And this again was because people valued their relationship over many years now with the bank. Had the crisis come 10 years earlier, it might have been different. But now it was set, these were the clients, it was their bank, and so they wanted to repay their loans to keep their creditworthiness, and they did. And the bank profitability with regard to the micro banking part of the bank sailed right on. They were profitable throughout the crisis, even as the rest of the financial system collapsed. So that was a real indicator. And also, poor people don't take their savings offshore during crisis. So the micro banking part was extremely stable during the crisis. They had a lot of liquidity, which nobody else had. So that was one experience in that crisis that was very, very interesting and I think important. There is a question about how the crisis, the present recession, the financial crisis, might be affecting microfinance generally. Now, if you look at all the different kinds of microfinance institutions, I think that the ones that, now there are variations by region, by country, for all kinds of reasons. But the thing which stands out particularly in my mind, aside from those which are there, is that the institutions that have savings from the public are very likely to come out of the recession, I think, better than those that are small, non-regulated institutions that are dependent on donors for their financing. I think they will have more difficulties, whereas the large financial intermediaries, who are the industry leaders, I expect in most cases to come out of it better off.